There are some things I'll take a chance on, but life is already enough of a gamble for me to put my whole nest egg in the share market. So I take a calmer path. By investing in private credit, I know my money could be growing, not yo-yoing.
From Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Hello and welcome to the COB on this Tuesday. I'm Andrew Gagan. Thanks for joining us here at AusBiz on Rates Day, when we heard from the Reserve Bank and leaving rates on hold at 3.6%, which was priced in, well expected by the market. Let's take a look at where we're at on the local market, having ended close to 0.1% lower. The market turning negative off the back of that decision. As I said, despite the fact that it was priced in and well articulated by the Reserve Bank, it would seem that this decision was coming. In fact, that was off the back of a decline in underlying inflation, which has slowed. That was the line from the Reserve Bank, the key headline out of its monetary policy decision. Getting to our themes of the day, inflation caution. So as mentioned there, just a little concern that slowing in underlying inflation is still the case. Also, we're seeing the miners' momentum. That is certainly the best performing sector there, as we've seen the gold miners continue to shine off the back of record prices of bullion, and more broadly what we're seeing among the miners today. And media merger, key merger on the local market there between Seven West Media and Southern Cross. Well, let's get to the sectors, those that have been moving today. I mentioned gold, having hit another record overnight. So this is where we finished up. Newmont has come off the back of some news there in relation to its chief executive, whereas the other miners, more muted gains today. Nonetheless, Ramelius there up almost 2.5%. Elsewhere, BHP also had another positive day. In fact, the iron ore miners doing relatively well, aside from Fortescue, which finished flat. And in terms of the energy space, that was perhaps the biggest drag on the overall market. We can see that the oil price having come off overnight, reflected in what we've seen with Santos, Woodside and Karoon, also Beach taking a tumble as well. In the media sector, off the back of that news of that merger, Nine Entertainment finishing in the green. Seven West Media surging 7% off that news. To the top news of the day, Seven West Media and Southern Cross Media are merging. Newmont's chief executive Tom Palmer is retiring at the end of the year. And CSL has a new CFO. Joy Linton will step down from the role next week and be replaced by Ken Lim, the current chief strategy officer. Orthocell's Canadian expansion is underway with the appointment of its first distributor for the nerve repair device Remplia. Star Entertainment has secured a loan covenant waiver. Flight Centre has confirmed that it is reviewing ownership options of the Pedal Group, but says the talks are still in their infancy. And IDP Education rising, Jefferies lifting the price target on a potential macro turnaround. And Electro Optic Systems climbing to a 5.5 year high there, as Bell Potter has raised its price target on the stock. All right, well, let's get across what we have seen today with a focus clearly on the Reserve Bank decision. Let's welcome Clifford Bennett, an independent economist, joining us again. Cliff, great to catch up with you.
Thank you for having me on your show.
I'm anticipating you would have been tuning in to Michelle Bullock and what she had to say there. I mentioned that headline off the back of its statement saying the decline in underlying inflation has slowed. What did you make of what you've heard?
Well, I did catch the press conference and I thought it was atrocious economics, actually. They seem to be an organisation that is very stressed at the moment about the rest of Australia finding out they don't have the faintest idea, in addition to those who've already figured it out. I mean, the reason we have high inflation at all is primarily due to, the reverberations, as we all know, from COVID and things, and tariffs are going to have a bit of an impact. But the main reasons domestically are higher energy prices and the Reserve Bank itself keeping interest rates too high for too long. I mean, I've said it on your show before, you increase interest rates to fight inflation when you have an overheating economy. At 0.6% on the quarter and 1.8% through the year, with the bulk of that being government spending, I don't think you have an overheating economy causing inflation. So everything the RBA governor just said is a little bit nonsensical and illogical. But they're clinging to their 1960s, 1970s textbook, which is that if we're worried about inflation, we'll keep rates on hold or raise them. I don't think they really understand contemporary economic forces, because in today's world, they're actually adding to inflation while the private sector of the Australian economy is a little bit vulnerable at the moment. I think we're all hearing anecdotal stories to that effect. And the public sector is not monetary policy responsive. So the fact that a lot of government spending is to do with our GDP numbers, our growth numbers, that won't be responding to the RBA's monetary policy up or down, so it becomes irrelevant. If you look at the private sector of the Australian economy, with unemployment continuing to remain quite firm, and as I said, anecdotal information everywhere that perhaps there are problems in the economy in the not too distant future, and I think this is a time when the RBA should have maintained cutting rates down to 2.75%, rather than pausing just in case. I mean, the governor herself said, we're not really saying this will happen, but, it could happen. Well, anything could happen. It smacks of a lack of courage and conviction, and an inability to use imagination to see over the horizon and only look at data, which is to conduct monetary policy in the rear view mirror at all times, which is why, they are the Reserve Bank of Australia. Thank you, Andrew.
Right. Well, yeah, certainly the governor there talking about they do remain data dependent. Look, Michelle Bullock also saying she described policy at the moment as being mildly restrictive. Does that indicate to you that they're almost at the end, perhaps one more to come?
Well, why would you want to have any form of restrictive monetary policy with a softening private sector? I noticed the governor goes on to say, but demand or something will be picking up. The economy will be picking up, but they've said that many times before and been wrong. And I can only highlight again that 1.8% through year GDP growth, which was an uptick, and 0.6% for the quarter, which was an uptick. These are not historically healthy numbers. These are historically a little bit worrying, in fact. You're not talking about strong growth, and so much more government spending is a part of that than has historically been the case. And also you do have immigration playing a role in propping up demand a little bit, that's for certain. And in that environment, though, existing small, medium-sized businesses, even some largish companies, they need some interest rate reprieve. Consumers are still battling with the world's highest, well, not the world's highest, but very high energy prices, as I said, a main driver of inflation. And the RBA keeping rates higher to fight inflation in that environment is just an extra burden, and itself causes stress to small, medium-sized, even large companies, who then feel they need to raise prices because of the higher interest rates. So to reduce inflation in an economy that isn't overheating, the RBA should be cutting rates. But of course, they're using a 1960s textbook. That's my frustration. So your question regarding moderately restrictive, I would say it's moderately to firmly restrictive. I wouldn't say it's highly restrictive, but moderately to firmly. And there's plenty of room to cut rates with zero impact on inflation. I mean, the setting of monetary policy in today's market and the kinds of inflationary forces that are at work in the Australian economy, monetary policy has little to no influence over those forces. And we really need to be taking pressure off businesses so they don't feel so much a need to be raising rates or laying off staff or just deciding not to hire more staff.
Meanwhile, Clifford, across the globe, we're seeing those elevated asset prices, certainly in equities. Also in metals, particularly precious metals. Are you seeing that they continue to run?
Well, yes. I mean, we've had 2 really strong years being long gold and I still am long gold and have clients still long gold, but did send out a note today, pointing out that pretty much the whole world is now long gold. So one of two things is going to happen. This US government shutdown, which no one's paying any attention to this time, because the 30 previous times it's happened, it really was, a false panic to worry about it. But it might be a little bit like the story, The Boy Who Cried Wolf. And so now no one's listening to this event, but this could be the most severe shutdown of them all. And what if the stock market had to play catch up? Why I mention that is that gold could skyrocket, like really accelerate from here very strongly should the government shutdown in the US become very severe and just spook markets a little bit with the edge coming off equities. The underlying background to the equity rally remains two things. First of all, excess liquidity, huge, massive government money printing and spending in the United States and some other Western nations as well. And of course, the technology revolution, which is gathering pace, but at some point, the valuations of projected future earnings, which haven't even begun to occur yet, get a little rich. So I'm just a little bit cautious in the short term. I'm long equities. I'm long Apple, Tesla, Johnson & Johnson. I'm long equities, but I have closer than usual stop and reversal. And it is linked to the gold price because if equities were to begin to correct on the basis of a severe US government shutdown, then gold could take off in a big way, I think, because people go, well, maybe I'll get out of equities now, but I'll keep buying gold because it's a hedge against disaster. And certainly that's what it's been. But it has underpinning it in the long term, just tremendous global, real industrial jewelry demand. So I'm bullish gold for the good reasons of gold, but I do think the market is very long at the moment. So one of two things are going to happen, massive acceleration. I don't usually say on the one hand or the other hand, but I am this time because it's really at a critical tipping point here, I think, whether it kicks on higher or not. So like my equity holdings for gold, I have quite close stop and even sell orders not far below the market, because if you did get a correction, it would be a medium-term correction. It would create great long-term buying for gold. But the reality is that once everyone who wants to buy a market has, they've become nothing but a sea of potential sellers. So that's just something I think investors should keep in the back of their mind in the short to near term.
Goodness, Clifford, you're sounding very much like an economist. On the one hand, yet the other.
I know, I can't believe I did that. Can we edit?
It's on the record now. Clifford, great to catch up. Thanks for joining us.
Thank you, Andrew. Great to be on your show. Thank you.
All right, let's get to our stock of the day. It was that headline that we heard there from Seven West Media and Southern Cross proposing that merger. To get across that, we heard from Mark Garner from NBC Markets and Francesco Destratus from Audmanet.
Does need shareholder approval by both parties, so that might be a bit of a sticking point. So if I go through things that are required, they're going to need some ACCC approval as well for cross-media ownership. So that's going to be a bit of a hurdle for them, I think. But when I look at the assets that both organisations have, then you got Seven West Media, which are free-to-air TV, so Channel 7 basically, 7 Plus, and the West Australian newspaper. So they got some sport in there. They got AFL, they got the cricket, obviously other TV programs. They have struggled a bit with profitability, so that might be a bit of an issue with some of the Southern Cross Media.
I get why they're doing it. It is an incredibly competitive landscape. And having that end-to-end where if you're going to go and sell media or advertising, being able to sell it across multiple platforms as one package, not only reduces cost to the companies wanting to do the spend, but you obviously would get some economies of scale there.
Let's get to the best and worst in today's trade then, beginning with the leaders. IDP Education off that broker upgrade there, up 16% today. Drone Shield again higher today. Capstone Copper, in fact those copper miners and the gold miners doing well, but Sandfire and South 32 also on that list courtesy of copper. On the negative side, checking out the energy sector, certainly been the biggest drag on the broader index, and Purenex also taking a hit today, as well as Telix Pharmaceuticals and WiseTech. The small cap, Veeam, We've just been discussing that on in regards to small caps recently. In fact, Dean Fergie, I think, was talking about that. Up 22% today. Bougainville Copper once again. Asara Resources similarly there with Native Mineral Resources and Cyprian Metals all doing well. Whereas those that have fallen, Southern Palladium, interestingly enough, Felix Gold taking a tumble today as an outlier in the gold sector, and Nova Minerals also lower. Tonight on the calendar, we get US home prices for July, also the job openings in the US, big week for JobStarter in the US, and the consumer confidence read in the US as well. And tomorrow, we get the Cotality National Home Value Index for September here locally. Well, let's recap where we're finishing negatively. The market did turn negative off the back of that RBA decision, despite the fact that it was well signalled and priced into the market, whereas we saw the opposite for the Aussie dollar taking a leg higher off the back of that decision to leave rates on hold at 3.6%. So also saw similar moves there on the ASX 200, off close to 0.1% at the close. That is the COB. Thanks for watching and listening.
The CIB is brought to you by Montgomery Investment Management. The world is volatile. Your financial future doesn't have to be. Find out more at montinvest.com.